This is Jonathan Mickles with the Strategic Multifamily Investing Podcast, and I have with me Vessi Kapoulian. Did I get that right?
You got it perfectly well. Yes.
Thank you so much for joining us. And I wanted to understand a little bit more. First of all, we're connected by a mutual acquaintance, Charles Seaman. Charles has been amazing in the multifamily world and doing his education and doing the work that he does. And so, how did you meet Charles? I guess in that regard.
Yeah, it was through the investing communities. We're a number of networks together, but the one that I most consistently connected with was the Saturday meetups. He does underwriting
Yep.
meetups. So I attended those quite a bit, at least in the beginning. But of course, various conferences, different groups. Over time, one conversation led to another, and he was in LA, which is where I'm based recently. So I finally, after knowing him for a couple of years, we finally met in person, face to face. But that's one of the powers of Zoom and online virtual connections. You oftentimes form those relationships before you meet face to face. But it was nice to meet him in person as well.
Absolutely, absolutely. So. How long had you been doing the underwriting Saturdays that Charles did? I don't think he's doing them anymore. But,
Yeah, I'm not sure because I haven't seen, and frankly, I dropped off after some time because things got
right.
busy on my end. But this was one of the first things I did is join a variety of groups as I started making the transition from a residential to multifamily, from being a lender to being an investor, right? I always approach those transitions from a point of humility and like, okay, there are a lot of transferable skills and knowledge I can take, but what else do I not know? So I think connecting in those smaller group settings and tapping into various resources, learning readings has been instrumental. So that was probably a couple years ago. I want to say maybe 2021, 2022 is when I started, and I gradually tapered off the Saturday sessions.
Exactly. So, I mean, once you get to a certain point of understanding, knowing what the process is, and Charles was so consistent that he was able to help a lot of people ramp up their understanding of underwriting and doing what they needed to do. And once you learn, no need to stick around anymore. You can kind of move on. But I want to ask, for those people who are probably brand new in the multifamily space or even in the residential space, you mentioned finding those groups. How did you find the group? How would you recommend someone new find some of these groups? And what kind of investment did you have, if you will, to join some of these groups?
Absolutely, yeah. It's so much easier now. When I initially started, it was really the local real estate clubs. And those are, by the way, great resources to start with in your local market, places where you can go to in-person meetings. So that's where my original journey started. And then, of course, COVID hit and all things became virtual. And one of the blessings of that transition was that a lot of these groups then became national, right? People started connecting online, virtually over Zoom. And then social media exploded with all sorts of subgroups within Facebook, within LinkedIn. Really, depending on your level of interest, you can join a variety of groups, and from there, one conversation leads to another, or maybe you ask people, hey, what other groups are you part of? And that's how you learn about other groups in your particular area of interest, because there's so much you can very easily get lost. So to a point, it's even overwhelming, and that's where I would say in the beginning, while you're still exploring, definitely having that breadth of connections and breadth of groups is great. So you figure out, okay, this is one area I would like to focus on and dig deep into. But once you figure out what that focus is, then I would say it's probably better to be more intentional and exactly more focused versus spreading yourself too thin, because it does become overwhelming after a while.
It can become very overwhelming. You wind up in 15 different groups and you're like, okay, which one am I going to do? Am I going to
Yes.
do short-term rentals? Am I going to do single families? Am I going to do out of state? I'm going to do in-state. Am I going to do
Yeah.
multifamily? I'm going to do single family, so many different things. So I want to add a couple more things there for anybody else that's listening that may want, okay, give me something to do right now. Okay, so go to Google, search your city, REIA. That stands for REIA, or Real Estate Investment Association. Just type your city, REIAs, and they'll come up. Go to meetup.com, type in your city and the word RIA or just RIAs in your area, and they will come up. Go to Eventbrite, type in the word RIA,
Yes.
and you'll see tons and tons. And as Vessi said, just go and learn and network. And so you start keeping a list of people and start adding people to a database, if you will, right? You may
Yes.
want to create another email address that's just for this, business and whatever, and then start adding people to that as a way of keeping, say, like if you're using Google, you do use Google Contacts, and then you can add everybody there so you can keep kind of a
Right.
CRM. Did you use something like that, or was there something more complicated that you implemented for kind of like your CRM to keep in contact with everybody?
Initially, it was just my outlook as I started making those initial connections. But as I became more intentional and focused on, wow, this is really what I want to do, and I want to. This is not just a small retirement nest egg for me. It's a much. It could be a business one day. At that point, I started professionalizing the systems and processes, and part of that for me included getting a customer relationship management or CRM. And I started with one that had a free version. That was a good way to test it out.
Which
And
one was that? Do you know?
yeah, that was HubSpot.
HubSpot.
Yeah, so I started with that one. Now I've transitioned to the paid version. They have different tiers, and the paid one has a few more capabilities that are helping even more with my business today. So, but it was a very incremental journey. In the beginning, it was okay. What is the tool you have handy? And for some people, it's Google Sheets. For me, it was I like Outlook, and from there it started. And your phone is a is a gold mine of, of contacts as well. But nowadays it's so much easier to organize things with all the capabilities that new phones have. So those are probably the two I was leaning in on in the beginning before I transitioned to a CRM.
Now, of course, I'm not going to bring you here for those just basic things, but for those people who needed that, we got that. You have been doing this business now for a period of time. Now, you started, you said, in residential. How
Mhm,
did you get to that? I read some of your background. How did
mhm,
you get to doing residential? And then I want to talk about commercial a little bit later, but talk to me
mhm.
about that process and why you went there instead of going with commercial first.
Right, right. Uh, Great question. I think residential is what a lot of people know, and myself included, right? When you think of multifamily, you typically think of a single family home. Also, part of it is my personal approach. I like to crawl before I walk, walk before I run, run before I sprint. So wanted to take very thoughtful incremental steps. And in my case in particular, so I live in Los Angeles. When I made the conscious decision to, okay, I'll start investing in real estate. My one of my key criteria was cash flow. So living in Los Angeles, to accomplish that would have required a substantial amount of down payment, which I did not have, given the price point of homes here. So naturally that pushed me to look out of state. And again, when you cross borders, in this case it was only out of state. It's not like I was going to a different country, but again, it was the mindset of, okay, let's start slow and steady. Let's not start with a large property. So I started with a single family home, and initially the idea was to build a small retirement nest egg to effectively protect myself from layoffs or events that I don't control, market crashes and whatnot, because I was very heavily invested in the stock market by virtue of my 401k. That first investment did well. Then it led to another, which was a duplex, and then that's when I think the light bulb went on, and I thought, wow, this is not just a small retirement nest egg. It can be actually a full or a steady cash flow income stream. And that's what prompted me to consider down the road multifamily. But as far as single family, that's how it got started. It was definitely small and steady, and overcoming those fears and limiting beliefs as well, because a lot of people will tell you, oh, don't invest in beyond the 5 mile radius from where you live. And I don't necessarily disagree with that. It's important to have that local knowledge, but it's not impossible to invest out of state as long as you build the right infrastructure, connect with the right people, including boots on the ground, which is a very important factor. Yes, it's not as straightforward, but it's also not impossible. And it felt scary, but I'm glad I overcame that initial fear.
Well, let's talk a little bit more about that, because there are a lot of questions that came up as you were running through that. So
Yes.
if I do rapid fire, I can always go one by one. So what led you to what state did you actually invest in when you went across the borders?
Yeah, so my first day was Tennessee. I invested in Memphis.
Why Tennessee? What research did you do? What led you to Tennessee and specifically into Memphis? Because there's Chattanooga, there's, other
Right.
cities that are there as well.
Absolutely. So I had started educating myself in terms of evaluating properties from an investor angle or an investor perspective. And through one of the local meetups, there was one particular investor who would often present, and he would usually at the end of the presentation would say, hey, if you have any questions about investing out of state, call me. So I decided to call him when I was ready to move
Can,
forward. And
can
I
we
asked,
give that investor a shout out? Who was that? If you don't mind
yes,
me asking.
no. That was Matt Owens.
Matt
Matt
Owens. Okay.
Owens. Yes. So yeah, I called him and I said, "Do you know of anyone who sells homes out of state?" And he said, "Well, I do." So I said, "Okay, send me your list." At that point, I was motivated to take action. He happened to be operating in Memphis. Now, coincidentally, I had visited Memphis a couple of times before, mostly for tourist purposes. Again, not necessarily as an investor, but I had some familiarity with the market. I did my research specifically on the neighborhoods and the area because that's very key, especially in the Memphis market where areas can be quite spotty.
Mhm.
And frankly, I decided to just take action and move forward. Now, are there other markets that could have been just as great? Absolutely. I mean, there are 52 states in the US, so you can get very easily overwhelmed thinking and pontificating, well, should I look at that market instead? Maybe I should do more research elsewhere.
Mhm.
You could do that, but at that point, I was motivated to just get started and get things going. So I didn't really overthink it. The opportunity was right there in front of me. I had done my research and I
So
didn't really want to get caught up in analysis paralysis, which is very easy for me to do because I'm also very analytical, but
yeah,
sometimes you just have to once you're informed and educated, you get to a point where you just need to start moving, regardless of how scary or uncomfortable it feels.
there you go. And Matt was the one who helped educate you about the area for the most part.
Matt, and I did my own research as
Okay.
well. All
Well,
this time
where
I
did
have
you where did
Mhm.
you go to do your research? I guess that's the question that I wanted to
Yeah,
find out.
so
What sites did you go to? Did you
mhm,
have a rubric or something that you found that you kind of filled in for that particular place versus some other place?
mhm. Yeah, so a lot of that came from initially from these meetups, but I vividly remember there was I don't even know how I got on their list. There was one email I got one day that said, "Hey, real estate seminar, 3 days, come join us." And when I went to the initial one, there was the back of the room behavior. Hey, sign up for this
Oh yeah.
5,000 seminar, which I didn't sign up for, but they had a follow-on meeting, and I'm so happy I went. I had to take the day off from work, which I did, and it was literally a full day seminar basically teaching you how to evaluate a property. So I took very detailed notes, and after that seminar, I literally built a spreadsheet with all the information of and a checklist. This is what you do, step 1, 2, 3. I built the spreadsheet with all the formulas, and then just started looking and practicing. Like, hey, if I want to invest in XYZ area, what do I do? So of course now it's a lot easier. There are a ton of sites like for crime activity, right? That spotcrime.com is a great site to go into. And I actually remember going to that one at the time when I was studying the sub-market, right? For the general market, Google is a great great resource to start with, where you initially, especially if you're not familiar with these sites, right? If you type Memphis population growth, and then you get the census data, and then you know, oh wow, the census has all that information and so much more, such as median household income and employment trends. You go to the, or you type in unemployment rate, and the Bureau of Labor and Statistics pops up. So then you know, oh wow, okay, that's the site I go to. So I'm oversimplifying things a little bit, but oftentimes the resources are just in front of us, right? You don't need something formal or complicated to get started. And of course, once you join these groups, and later on I joined the mastermind to kind of formalize my education in specifically in the multifamily space. But the resources are right there, and you can just get started. And of course, the networks, talking when you go to these meetups, always asking people, well, which side do you go to, or which area would you go to check that? So of course, I received the information at the time from Matt, but I did my own homework, right? Because you always want to make an informed decision as an investor, and that was also important for me to make sure
Right.
I made a decision based on that. So yeah, those were some of the steps I took to get started, get educated. So when the opportunity was there, I had already done a lot of that legwork. That's, I would say, very important, the education piece.
Absolutely. And if I can just add a couple more education pieces for anybody who's interested in most of these are free, especially if you're looking for markets. And exactly as you mentioned, going to Google and finding all that information about, the average population growth for a particular area, et cetera. There is a gentleman by the name of Neil Bawa, Bawa, who is considered the mad scientist of multifamily real estate or real estate, who does a lot with numbers and things of that sort. If you're familiar with Udemy, right? Udemy is the educational platform. He actually has a course there that's for free that teaches you how to analyze a particular market and multiple markets so that you can kind of compare this market versus that market if you're interested. Another one that I've learned is a free tip, and again, this is free. Just go and Google the U-Haul annual report. Like, well, every year they put out a list of the 5 or 10 cities that people are migrating to and the 5 or 10 cities that people are migrating from. Well, if you look at the places where people are migrating to, that's where the jobs are growing, right? So we talked about the average job growth and whatever. So as you're comparing these different things, right, these different places, whether you're going on Google or you're on a call, just keep a list of all of these cities. And as you keep hearing the same city, put another tick by it, because that may every time you hear a certain city multiple times, you'll then have like this whole tick list. Oh, I've heard this city 10 times. I've heard about this city 3 times. I've heard about, well, maybe we'll go and investigate the one for 10 because there's so many people who are talking about this particular market. That may be something that you can do. Also for spreadsheets, you are excellent at spreadsheets. You know how to underwrite. I want to talk about some of your underwriting and where we're going. But before we get there, if you're not very good about spreadsheets, you can go to Michael Blank's syndicated deal analyzer spreadsheet that a lot of people use. There's even an AI version of that type of spreadsheet with another organization. I can't call it right now, but I also know that Michael Blank, who I learned from initially, has his apartment course that used to be like a couple $1,000s is now free. So I think he just advertised that on LinkedIn, and we're in June of 2024 when we're recording this. So feel free to reach out to Michael and his team. Maybe they can do that for you. But that's enough of other free resources. Thank you so much, Vessi, for that. So with respect to you going out of town, a lot of people say California people have major money, and that's a wonderful thing in comparison to other places, in the country. The type of mortgages, what kind of, financing did you have to get together in order for you to start investing? I mean, was it 20% down, or how did you get yourself together financially to start walking down this path?
Yeah, so again, at a lot of these meetups, right, you meet lenders. That's one of your strategic partners. Frankly, your biggest strategic partner, because typically they bring in the residential space, it could be 70 to 80% of the capital, and in the multifamily space, 50 to 60% of the capital, at least in the current market environment. So you meet a lot of lenders, you make connections, but in the residential space, the process is a little different, at least 1 to 4 units. And at least for the first 10 units, typically how the lenders evaluate borrowers, including investors, right, is based on their W-2 personal income. Yes, of course, they look at the property because that's their underlying collateral, and they want to make sure it's in a nice area, that it's in good shape. So they'll do diligence related to that. But ultimately, how they underwrite you is based on your personal income. And so from a loan to value perspective, typically as for your first home that you own or personal residence that you reside in, it's 80% for investor loans. Then LTV typically drops to 75%. Personally, I don't like to over leverage myself, so I don't like to go above 70, but that's more of a personal preference or personal risk tolerance. But there are lenders who may be able to do more than 75%. And of course, depending on how leveraged you are, then that will determine the pricing for the loan and if there will be any other conditions or requirements that they may add to it. But in the residential space, it's pretty simple. It's based on you, they underwrite you as an individual and your personal balance sheet and income.
So then you mentioned your personal preference at 70%, where other places may give you 75, 80%. Why that preference? Help me understand that.
Yeah, so I don't like to be over leveraged because I'd like to maintain financial flexibility. And I think for those of us who were around at the time, it is the 08, 09 financial crisis, now known as the global financial crisis, taught me that, right? You need to have a strong balance sheet because that's how you're able to weather the storm if or when the storm arrives, and or if you want to grow during the storm and go buy a lot of properties. So having a strong balance sheet and a ton of liquidity, but also helps mitigate the risk for a potential market fluctuation, in this case, market decline, right? So if the market drops by 30% and you're only 30% levered, you have that much cushion. When you start, of course, over time, you pay down the principal. So over time, that cushion continues to grow, all else equal. But for me, it was more of a risk tolerance factor. Right now, there are people who are more comfortable with higher leverage. And of course, higher leverage would yield a higher return, but it also means higher risk, right? So for me, it was more of a risk factor consideration than anything else, because the property would have cash flowed either way. Whether I got a 70 or 75 or 80% loan, it would have cash flowed anyway. But my own risk tolerance kind of put the tap on the 70 mark.
Gotcha. So then even with that, you want to have some reserves. So
Right.
because while you're not over levered and the market takes a tank, if you have a single family home and you're unable to rent it for a little while, now you have to pay the mortgage, if you will, on that
Right.
single family home for a
Mhm.
period of time. And so that's absorbed by potentially a cushion. So what kind of cushion or reserves, as we call them,
Mhm.
would you have, for any property that you're working with? And do you build that into your underwriting?
Yeah, so I do this both in the single and multifamily space. Of course, in multifamily, the structures are a lot more complex, so the amount of cushion is a little bit higher. But I would say in the single family space, probably around 6 months of reserves will get you there at least. Of course, if you have more, that's even better cushion. And then the other factor is that only assumes you have one property, right? As you start accumulating a portfolio, then if God forbid one has a prolonged vacancy of say a year, right, then there are other resources you can tap into by virtue of having that global liquidity, if you will, that you've accumulated across the portfolio. And of course, last but not least, and that's also why lenders typically evaluate you as an individual, at least in the residential space, it's your W-2 cash flow as well, and making sure you don't live beyond your means. So again, if or when a rainy day arrives, you have those means to step in and support your investment if or as needed.
Got it. So then let me ask this question. I'm pivot a little bit
Mhm.
towards, you stepping outside of, California and then going to Tennessee and other
Mhm.
markets that you've gone to. Granted, you had Mark to help you to do some research. You've done your own research, but then
Mhm.
ultimately you buy the property. You're not in Tennessee to actually manage the property. How
Mhm.
did you go about vetting the team, the property manager, the whatever, in order to make that happen for you so that you're not having to be in Tennessee every other month collecting
Correct.
rent, unblocking toilets and things of that sort from California? How did you do that?
Yes, and you hit the nail on the head. It's imperative, right? I think to get a property manager. I do know investors who manage out of state, but again, I had a W-2 job, so it wasn't something I could really afford to do full time. So I asked Matt, right, if he had any recommendation. Now he happened to at the time have a property management company, but even then, after those initial conversations, I actually flew there, at least for that initial a meeting, because I wanted to meet the team, just face to face. Again, phone conversations, and now, of course, we have the power of Zoom, which was not existing at the time. But those are all very important. But flying there in person, walking the neighborhood, I spent the night. Intentionally, I stayed in an area that's close to the property just so I can get a feel, see how it is at night, see how it is during the day, just get a feel for the neighborhood and just the overall area. And then of course, next day I met with the property manager, we went to their office, we toured different properties that they managed at the time in that market, which really gave me a good feel of how they operate. But really, I just wanted to make sure I'm doing real business with real people. So that was important in building that initial relationship. And then, once that happens, once you see how the property operates, once you build that at least initial level of trust, right? Then for the second acquisition, I didn't necessarily fly over there because we already had established a good working relationship. But at least for me, it was important to have that face-to-face visit as well as the boots on the ground visit.
I'm over here nodding my head and nodding my head because I think that's the secret sauce, the secret juice. If you're going to be investing out of town, you need to go with yourself or anybody else that's really close to you to
Mhm.
go and actually talk. I think sometimes that unlocks even, those sellers who are interested in potentially selling the property to you, especially if you're in a multifamily space. If
Yes.
you show up yourself and you walk and you talk and you shake hands and you get to do some things. I remember back in 2016 when I was interested in getting to Arizona.
Mhm.
Yeah, it was in Phoenix, and I went out and I shook hands and I sat down and I started talking, and all of a sudden I'm sitting there with the broker and the owner, and we're going back and forth, and they're trying to get me to buy on future numbers instead of actuals, and I'm like, and literally, while I'm sitting there, the owner pulls out and says, "Now here are the actuals, and here is all of this stuff." And the broker is sitting there like his eyes get really big, and he's like, "Okay, I'm not going to say anything because the owner is disclosing. I'm not disclosing." So, he was fine, but that would not have happened if you weren't sitting eyeball to eyeball, having a conversation, really sharing about
Right.
exactly how things are. But that was when you could buy for an eight cap. But you can't do that in Phoenix at this point in time.
Those were the days, yes.
Those were the days. Yes, absolutely. So that was excellent. So I also mentioned here just a couple seconds ago, if it's just you or if you have a spouse, did you have a spouse when you were working on this? And
No partners, and unfortunately, in my case, I didn't have family. I was going to say if I had family in that area, that's or someone you trust, you really trust, that could be another resource you can lean into to scan the area, give you good feedback and on the neighborhoods to avoid or neighborhoods where you want to be in. But in my case, I didn't have any, which is why I had to rely on myself and physically going there.
got it. So in Los Angeles, do you have a spouse in Los Angeles as well? Or, did you have a conversation with them about you potentially doing investing?
No, no, I not really. I mean, I shared with my family, with my immediate family, but no spouse or partner, nothing like that. Yes.
Yeah, because I know sometimes that could be a challenge for some is, hey, I'm going to go do this thing. And then you have to kind of get it cleared through your spouse before you do any of that.
Right, right. That
So
makes sense. I mean, because basically a team, right? So there needs to be good alignment. But no, that I didn't have to go through those conversations in my case. Yeah.
So tell me, we've been talking about the good stuff, the good stuff, the good stuff. Talk to me about something that went like wrong, horribly wrong, that you said, no, I've learned this lesson. I need to correct this. Give me an instance of one of those.
Oh gosh, there's so many. I'll speak with my first multifamily property because again, I'm a former commercial lender, and I just assumed all lenders work the same way I do, but I found out the hard way that was not the case. And specifically, as I was looking for properties, I was concurrently building my team, my deal team, a part of which of course includes the lender. There was one lender in particular who would always respond very timely with tentative terms, which was incredibly helpful for me at the time, because especially when you underwrite a deal, right, and especially if you think you will be submitting an LOI, you want to get as close to reality as possible. Granted, a lot of things change during the diligence process or may change, but you want to try to as close to reality as possible. So having at least a preliminary lender term sheet helps. So in my own little mind, I thought, well, this individual has invested a lot of time in me, so really it's just a matter of time. When I find a deal, it will be his to lose, basically. So when the deal did arrive, he presented a term sheet, we went all in. That's also when the time when the Fed started raising rates. So knowing what happened, I started checking in with him periodically. Hey, are we still good? Is the original offer still good? And he kept saying, yeah, no problems, no issues. And I'll never forget, it was a Friday afternoon. I had my periodic, hey, are we still good? We're starting with the appraisal and this and that. He was like, yeah, rest assured that we're good. No stress, no worries. Monday morning, so it was just the weekend over. I got an email. It wasn't even a phone call. That said, hey, we're shutting down this product. Good luck. We're no longer lending. I'm like, I'm already under contract, and you didn't even bother to at least give me a call. You just send a cold email, good luck, and that's it. Disappeared. So I learned my lesson the hard way. Of course, when you have these moments of crisis, right? You lick your wounds, you cry for 3 seconds, and you have to get up and move on and
Yeah.
figure out what is the solution, because you have other stakeholders. In that case, my JV partner. Of course, you have the broker, the seller. So before calling the broker, which I knew I had to do, right? Because I feel it's important to disclose this, versus stick your head in the side and pretend like it didn't happen. Is figure, okay, what are we going to do now? Throughout this process, of course, I had started conversations with other lenders, and my partners also had lender connections, so we started reaching out to those lending partners. So by the time I called the broker to break, unfortunately, what was bad news at the time, I didn't just drop the news and disappear. I said, hey, this is what happened, but since then we've reached out to XYZ lenders, so many lenders. This is who we're still pending responses from. These are the ETAs they're giving us. Rest assured, we're moving forward. We still like the property. It meets our criteria. We'll proceed with diligence. And just to give them the reassurance that we're not just going to disappear, but also make them aware that we've encountered some challenges which may lead into potential delays in closing, which inevitably did. But they were aware of it, and they saw that we're diligently working through the steps. So that was a very important lesson for me. One is definitely don't assume that everyone work like me, but form relationships with multiple lenders, and not all of them like that, right? They don't like to be shocked, but what if a situation like that happens, whether it's intentional or not? In that case, the communication was handled very poorly, but sometimes loan providers go through their own challenges, and yes, products do get discontinued. So you always want to have a plan B and a plan C, because again, this is not just about you. There are other people who depend on you in those types of transactions, whether it's JV partners or whether it's GP partners and investors, of course, the broker, the seller, insurance provider. There are a lot of people involved, so it's important to stay coordinated. So loyalty is important, building relationship is important, but it's not everything. So you always want to have a plan B and C if or when those unfortunate circumstances arise.
So then let me ask this question. Then you mentioned a lot of partners and having to communicate with them. And
Mhm.
First of all, kudos to you. You know, a lot of times when bad things happen, we want to go and put our head in the sand, right? We can't do that in that situation because as an operator, that's who you are, right? Operating in that situation, you're the one who's leading or helping to lead the team.
Mhm.
You're on the front line. You get the praise as well as all the bullets, and you've taken you took one there for the team, which you were able to respond. So, did you communicate with any of them via email as you had been communicated with, or are you picking up the phone to each one of the partners along the way and you're following some sort of a project schedule kind of thing? How are you communicating?
Yeah, so with a group chat, because to the extent news happen, you want to share them with people at the same time, so they'll have the benefit of the timing, right, of finding out the news, and we all came together as a team at that time, right? It wasn't just, hey, these are my contacts. Everyone contributed contacts, ideas, suggestions, so we all came together as a team, and then yes, we did have a group phone call as well, but I didn't want to create anxiety and say, hey, I have some bad news. It's like, hey, this is what's happened. Let's get on a phone and figure out how we want to proceed. Because frankly, initially, we weren't even sure if we'll be able to proceed with the property until after we identified some options.
So we're about to get to a couple of different things because you've mentioned your team and others and JV partners and things of that sort. Let me ask first of all the technology you use for the group chat. What were you using then for the group chat?
Very simple, just text message. And since then, we've transitioned to a WhatsApp group because later on we had one international member join, but just the resources you have handy, which was group text.
Yeah, that's fine because some people get a little bit more sophisticated. They use Slack or they may use a Google
Yes.
messaging thing and whatever. And
Yes.
so it's just as simple as just a group text. Okay,
Yes.
cool.
And it
Um,
was a small group. It was just 4 or 5 of us, so it was very easy to manage in a group text. Yeah.
so you mentioned 4 or 5 of us. So you mentioned JV partners
Mhm.
versus syndication. Were you doing syndications or were you doing JVs?
So my first multifamily deal was a JV. Again, I want to crawl before I walk. So I did a JV first, and since then I've transitioned to syndications, and now I focus on syndications. But again, just like similar to the residential space, I did a single family before I did a duplex. I followed that same strategy with doing a smaller unit count property before I transition into larger ones.
So for everybody else, what's the difference between a JV and a syndication?
So a joint venture or JV is typically formed with a handful of partners. It could be anywhere from two, I would say probably maximum to 5.
Mhm.
Typically, that applies to smaller properties where each and every one of you brings the capital almost, I would say, on a pro rata basis.
Mhm.
And each and every one of you is very actively involved. Everyone has a different role, different responsibility. So it's a very hands-on experience where you're running the property. With a syndication, that typically applies to larger properties that require much more capital. And so there you still have the core management team, which again could be around 5 people. Uh, but in that case, you're also working with passive investors who would like to invest in real estate, but don't necessarily have the time or desire to be involved in a managerial capacity or want the responsibility of those daily decisions. So in that case, you work with passive investors, but then the core management team is still a handful of people because they're different jobs, so to speak, that everyone has that help in managing that property, which is effectively like a mini business. It's almost like running a small company.
It is. It is. Every property is its own business, its own LLC for the most part, and everybody has a portion of that. So I do have another question though, in terms of these JV partners. Where did you find them? How did you vet them? And as you got larger into larger and larger, you know, roles, I'm pretty sure you weren't necessarily the lead on those larger ones, but you were part of the management team, if you will, the
Mhm,
GP, as we would call it in the syndication. How
mhm,
did you find those JV partners? How did you vet
mhm.
them? What were the characteristics that you were looking for? Because, that can make or break your career, if you will, and even moving forward. So if
Yes.
you could share with me about that, that'd be great.
And I'm so glad you asked this question, because for anyone coming into the space, I would say yes, definitely get educated is the first step. But secondly is finding and aligning with the right partners, because that is key. In my case, I took the time. I don't easily jump into relationships. So how I got connected with them is through a mastermind that I was a part of, or one that I joined, that specifically focuses on multifamily and investing in joint ventures and syndications. And within that mastermind, there are different networking events or opportunities to connect with others and at least initiate conversations. So in the beginning, while I was also looking for properties, I was very heavily networking to figure out who my future partners would be. Do we have alignment? So that could happen in a number of different ways. One was the more formally organized events within that mastermind, where you have an opportunity to meet people both in person as well as virtually. In my case, because at the time I had decided to focus on finding, acquiring properties and underwriting as well, I was effectively helping a lot of people, I mean, for free, if they needed a second set of eyes on the underwriting, or if they needed help underwriting. And so with some of them, we looked at one, then two, then three, then four deals together. And before you know it, some of those bonds start forming, those conversations. You figure out how they communicate, right? Are they an email person, text person? Do they respond timely? Some people don't care about that, but for me, responsiveness is very important, right? Do they respond on a weekend, mornings, evenings? You figure out each other's styles, how compatible you are. You learn about their families, you learn about their values. Again, that doesn't happen overnight, right? It takes multiple conversations, multiple touch points, and understanding their goals, is their alignment, and then really understanding the compatibility of the skills, right? Because if all of us are underwriters, who's going to bring the capital, or who's going to manage the property? So in that case, it was important to identify different strengths, right? So we have someone on the team who's has a property management company, and one is local, and they're really into they have experience with rehabs projects and dealing with contractors, finding local vendors. There's another one who's really great about the administrative aspect and being super organized. So everyone has their areas of strengths that and then you get together and decide as a team, hey, what roles are we going to play? Of course, we all keep each other informed as well, because if, God forbid, tomorrow I get hit by a bus, right? The information still needs to be there. Everyone needs to be informed of what's happening at any point of time with our property. So the knowledge is there, the documents are there, everything is shared, but we each have our own unique roles and responsibilities. But to get to that point, it took a lot of conversations, and as well as working together on what I call mini projects. And that's a good way to figure out how you align with people.
Mini projects. Help me understand what mini projects are.
So it was like the example I gave on underwriting. So when they were looking at a deal, they would bring me in because they knew, oh well, this is good at underwriting, so let me seek her help either in underwriting that property or giving me a second set of eyes. So it was kind of like almost like working on a deal, but not really, because it was an hour deal, right? So that would be an example of one of one called mini project.
So that was excellent. Let me give some I guess a kind of a summarization of what I think I heard you say. You said being of service. You know, hey, I'm looking at this thing and I'm doing it for free. I'm being of service to the community, and at the same time, I'm educing who everybody is around me. This is the person who communicates via email. This person communicates via phone, etc. What we call those in project management world is we do stakeholder interviews, in so many words. These are all stakeholders, right, that are in the project, and you want to interview them to figure out whether or not they're a push-pull person, meaning, do I need to send out a report? If I have to send out a report to make sure that you get the information you need, that's a push person. If they need to call me in order to get information, that means they're a pull person. And then my next question to you is, you mentioned that the documents are here, et cetera, et cetera. what is the system that you're using to kind of organize, these mini projects or projects in general? What, and it may not be one tool, it could be multiple tools. What tools are you using?
Yeah, so for our existing team, we have like a shared drive, like a Google shared drive, Google Sheets, and then for the calls, we record all of our meeting calls via Zoom. So we utilize Zoom. So if for whatever reason a person needs to miss a meeting, which happens, right? They can look at the video, two, they have the minutes, so someone does the minutes via Google Sheets afterwards. So I would say that has been helpful. And then now we have a WhatsApp chat group that's, I guess, maybe a little bit more user-friendly than just a simple text group that you set up on your phone, because then you can do other attachments and things there if needed. So in between meetings, as updates come along, we can share experiences or news updates, whatever comes along. These are not really sophisticated, right, system. Now in my syndication group, I work with a larger operator. Now they have a whole slew of more sophisticated systems that they use, and then we tap into that as part of the co-management team. But for the JV, it was just that simple. And then for those initial mini projects that I mentioned as part of the mastermind, it was literally getting on a Zoom call or swapping the information over email. And of course, everything is kept highly confidential. I don't go tell the world, hey, they're looking at that deal. So it was important,
Exactly.
the
Yeah.
confidentiality, and make sure they know they can trust with the information that they share with me.
Yeah, a lot of times when we start talking, you and I know of this stuff, like the back of our hand. It's like, oh yeah, you use this. But sometimes people who are brand new don't know exactly what tools we're using. We're using all the basic tools that most people use on a day-to-day basis anyway. But by having them and putting them, say, in a Google Drive like you have, along with the recordings, also creates a paper trail for you to establish a pre-existing substantive relationship with someone if they're looking to potentially invest with you in the future, where maybe they are going to be a passive investor. And that's something that you need to have, if you will, if you're going to be in a syndication where you have somebody who's passive and someone who's active. You need to be able to basically prove, just in case you're audited, whether or not you actually do have a relationship with this person. And having these mini projects is a way for you to be able to say, yes, we work together, we talk together, I understand where they're coming from, what their risk tolerances are, et cetera, et cetera, et cetera. So, when things go in, we can say we've had some relationships. So that's great. So I have another question here, and I have two more questions that I'm going to let you go because we're almost at an hour.
No worries.
You mentioned that you were a commercial lender yourself, and so my question is, was there not a provision for you to self-deal and do underwriting for your own deals? I mean, what type of lending did you do? You could talk to me about that.
Yes. So I specifically started in the international middle market lending space, and that's working with actual businesses, operating businesses that have very heavy international exposure. Then the opportunity came to get promoted, and that's when I transitioned to the domestic division of the bank that I used to work for, and that gave me really the exposure to real estate, because a large chunk of our business was real estate. Previously, I was doing some real estate lending, but it was mostly owner-occupied types of properties, which are underwritten slightly differently than your traditional investor real estate space. And that was one of the many aha or light bulb moments when I realized, well, I'm actually sitting on the right side of the equation. To answer your question specifically, there weren't any quote unquote restriction because I wasn't necessarily competing. I kept a very clear, call it Chinese wall between the businesses. Again, if or when I needed a loan, I would treat it, even for our JV, completely like a third party. I wouldn't get a loan from my employer, just to keep that barrier, if you will, and remove any potential conflict of interest. And again, I wasn't necessarily competing, right, with my employer for business, and I was doing this as an investor, right? Not necessarily, I wasn't out there selling loans or looking for borrowers. So that really helped create a nice, clear Chinese wall between what I was doing on the side as an investor versus my W-2.
Yeah. So by not using your commercial lending experience in this space, meaning your connections with your employer to get the
Right,
loans, was a beautiful thing because again, to let everybody know that you were an honest dealer and you weren't, if you will, double dipping, as
right,
a result of doing that.
right,
Excellent.
right. Right. I wasn't, I mean, even talking about this to my colleagues, I wasn't soliciting anyone. It was just a very, um, literally building a Chinese wall from a relationship perspective to remove any and all potential conflict of interest. Yeah.
Got it. So you mentioned that you were working initially with the Middle Market International, and then you got promoted and you were doing some things. So sometimes with promotion comes a lot more responsibility, a lot more time, a lot more effort, a lot more energy. And
Mm-hmm.
so you're doing that and also doing this. So it's kind of like home, even though if I understood you correctly, you don't have a spouse. So you were doing it as a single person, you still have a life, you still have family, you know eh, how did you manage all of that? Did you break up your day in a certain way? Talk to me about how you did that.
Yes, it's extremely important to stay organized and really keep your why. Your why is really what pushes you because, yes, there are extra hours involved. I won't sugarcoat it. You have your 8 to 5 job, right? And so then I was very intentional about how I take my breaks, including lunch breaks, what I do before 8 o'clock, what I do after 5 o'clock. So you have to be extremely organized, set your goals. One book that actually helped me tremendously was The One Thing by
Yeah.
Gary Keller, where it was a lot of times your list is pretty long, right? But you focus on, okay, what are the 3 things that I'll accomplish today? And of those 3 things, what is the one needle mover? If everything else fails, what is the one needle mover I have to do today? And then I'll catch up on 2 and 3 tomorrow if needed. And I promise to catch up, right? You don't just let your list grow and grow. So that helped me tremendously. Time blocking as well. So
So give me
say
an example of your time block, because you mentioned, anything I do before 8 is my time, anything I do after 5 is my time. So give
Mhm.
me an example of what your day would look like. I mean, what time would you wake and how did you work up until the 8 hour, and then what did you do after 5?
Yes, yes. So to the extent there are any, for example, a lot of the properties I was looking at were on the East Coast, so that early morning was actually working really well because my 6 a.m. was already their 9 a.m. or start of the day. So to the extent there are any follow-up emails or calls I needed to handle, those would be usually reserved for the morning. To the extent any calls are happening, especially like JV meetings and things like that, those would be usually lunch hours. And then after 5 is when I will do, I don't want to call it administrative, but like underwriting properties or looking for properties, a lot of the things that wouldn't necessarily require a phone call, which again on the East Coast would have been 8 o'clock in the evening, or things that if my partners need help with, right? I would look at it after work. And a lot of it also depends, right? Some days you had 1 or 2 properties to underwrite, so I knew, okay, on that day between the hours of, between the hours of, let's call it 7 to 9, I'll be underwriting. And I say 7 to 9, why? Because 5 to 7, I may be at a real estate meetup on that day. So then 7 to 9, I'll be underwriting the property. If I didn't have a real estate meetup, maybe I'll underwrite some more, or in the beginning as I was getting educated, particularly from an operator's perspective or an investor perspective. It's sitting through the modules or the course or doing the homework. So for every day, I will have a task, whether it's a meetup, whether it's a homework, whether it's a underwriting 2 properties or starting a model, whatever it may be. I will have at least those to-do lists and literally block the time and make sure I do it before I before I go to bed.
So question, how many properties would you underwrite in a week? And what would you suggest for, say, a newbie who's doing this to kind of underwrite? Because that's kind of like your pipeline to know whether or not you've got something moving. What
Yes.
what how many would you underwrite?
Yeah, so at the time I was focused on acquisitions. Since then, I've shifted my focus more on capital formations. But when you're in acquisitions, right, you look at a ton of properties. And I also want to give the perspective that at the time the market was extremely active or very, very hot. So there were a lot of properties on the market. Since then, deal flow has declined by 50 to 60%. So there are not as many. And so I'm just sharing that for perspective. But at the time, when there were a lot of properties, I was underwriting about one a day on average, right? Sometimes there may be days where nothing would come and then you get a spurt of seven and you have to underwrite all of them. And I was tracking every single one I would track, especially in my market, because that also helped me learn the market over time, which is why it's extremely important to be focused and not jumping from one city to the next. So just to give you an example, for my JV deal, before we got that particular contract accepted, I had underwritten over that 180-day period. I had underwritten about 180 deals. Of those, only 5 were LOI worthy. We didn't win all LOIs, but that one last one we did. So it required a lot of faith, a lot of patience, a lot of perseverance, and really not giving up and believing in the process, believing that if you focus on the process, the results will follow. So it was very, very uncomfortable, right? Saying no, very discouraging when you get a property and you see it doesn't work, then you get to number 20, 40, 60, 80. Like, gosh, how many more do I have to look at? So different dynamic now. Of course, the deal flow has reduced significantly, but that is not a reason. If I was starting today, I would probably follow a very similar approach, which is not giving up, and maybe it's going to take a year versus 6 months to get to the first property, but it's being consistent and persistent.
Let me ask a follow-up question to that. Excuse me, I didn't mean to cut you off there. In terms of keeping the faith and keeping your team, activated, because when you get to 90 and you hear a no, based on what you're saying, 180 days, you still had another 90 properties
Right.
to underwrite. You've got 90 no's and you've got 90 more that you've got to do, and there were 5 maybes in that total 180. How did you keep the team, or how did you all keep each other encouraged to say, we're still in it? I haven't, moved this money to another deal. I'm not, going off to go do something else. How did you keep all of that together?
It really comes down to your why. I think it's your why that propels you during good times and pulls you up during tough times, is what I'd like to say. And really taking a step back and remembering, why am I doing all of this, right? And then also setting realistic expectations, right? If it was easy, everyone would be doing this, right? I think through conversations, not only with my partners, but also the mentors I had along the way, I understood, and also having been a lender previously to that, right? Real estate is not a get rich quick scheme. It's not, things are not going to happen overnight. So one is, I think I had the right expectation, but two is the motivation and the determination to keep moving forward, because I had a very strong why to continue doing so. And I think the same applies for my partners. Granted, not all 180 deals I underwrote were deals that necessarily we were going to be doing together, but especially on the ones that came really close, right? I would give people heads up. Hey, there may be this one. What do you think about it? Because some of my partners, right there, and they were in my market, so it was important to get their perspective. So and periodic phone calls as well, touch points. So we're all connected. Although, like I said, I would say a lot of those relationships started forming closer to the deal date. In the beginning, there were a lot of pieces, and I wasn't only focused on finding deals, but also building relationships. So those partnerships didn't necessarily emerge during the first 50 deals, right? They emerged late. Yeah.
Gotcha. I understand
Yeah.
that.
Yeah.
I've got some follow-up. There's some follow-up questions there. So, there's a couple of situations where I found some people who could be KPs or key partners, right, that are part of
Yes.
the GP, you understand what that means. And these people often are the ones who are bringing maybe the majority of the money,
Mhm.
or are going to be able to sign for the mortgage, because just anyone can't sign for a multifamily mortgage, right? They want to
Mhm.
see track record that you've done so many deals within the last 3 years, and that you have X amount of cash flow or net worth above
Right.
and beyond what's the property is worth, and that the team together is probably raising 10% of the total raise that's out there,
Mhm.
which can be very challenging. Oh wow, so many more questions have popped up. So what happens when your KP or your multiple KPs are not returning your phone calls? You're having conversations with them and they're not returning phone calls. What are you doing then?
Got it. Yeah. I mean, thankfully it didn't happen. In my case, the first deal was JV, so we were all together and I happened to be the one signing on the loan. So that wasn't, but I guess if I was to run in this situation is, I mean, hopefully pick up the phone and call them just to say, hey, really want to know where you stand. Like we have a deal and um make sure we're on the same page and just ask the question directly, because at some point you have to move on, and whether it's you walking away from the deal because for whatever reason you didn't have the right team together and you don't want to lose the earnest money. But in other cases it's literally like picking up the phone. If the email doesn't work because it landed in spam or for whatever reason, text them. And if the text doesn't work, I would say then call them. And hopefully by the time you decide that you're in a deal together, you have that understanding of mutual respect, that where you can be direct and straightforward with each other, of course, in a nice, respectful, professional manner, where you feel comfortable asking that question. Hey, haven't heard from you in a week. Are you, did you receive my message? Wanted to make sure my message reached you. And if it didn't, here's the situation. Are you still interested? Has something changed? Just so you have clarity as well in terms of where you are. But also in the beginning too, when I was sourcing deals, because I wasn't just sourcing for myself, I was looking to find deals for larger operators, because for exact same reasons that you mentioned, where I knew I wouldn't be able to take it down by myself or even with my partners, right? Lenders would look at a certain liquidity requirement, net
Mhm.
worth and experience level, a lot of other factors. So oftentimes when you bring those to a potential sponsor, right, I found what I found helpful is understanding their timelines and their process as well, and following up within those. So if I knew, okay, it takes them, they would say, for example, when you send us a deal, it takes 2 to 5 days to review. I'm like, okay, I'll give them the space, we'll review. But if I don't hear back on day 5, I'll be reaching out and following up. If they don't respond over email, then I would text again, just to make sure my email didn't land maybe in the wrong folder. And then finally I would call. But in most cases, having that clarity of timelines and establishing the communication parameters really helped. So even in those cases, I would say the process went very smoothly. Of course, sometimes responses do take longer than you'd like them to, but I think setting the right expectations and establishing the communication guideline up front is what was helpful, at least in my case.
More questions. You keep giving me
Yes,
such good information.
I'm happy to.
I'm,
Yes.
I'm trying to land. So, are you comfortable sharing what your why is that kept you, moving forward?
Yes, yeah, and I've shared that with friends, family, investors, so happy to share that here as well. It ultimately for me boils down to living a life of positive impact and significance. And not that I could not accomplish that through my W-2 job, for example, which I also found very meaningful. But real estate for me was just a vehicle, one of many vehicles, one of many tools that would enable me to have that positive impact, have also the time freedom, also not for to do the things that I want to do, to spend time with family, dedicated to activities and causes that I'm passionate about. So again, real estate was the right tool for me. I'm not saying that will be the right tool for everyone, but it ultimately for me boiled down to, okay, if I'm gone tomorrow, what do I leave behind? And that's not always physical or material things. It's how you impacted people around you, and hopefully you did that in a positive way that changed their life in a positive direction.
That's beautiful. Well, I will not hold you further. We definitely probably need to follow up another time. Are you working on anything right now that you want to tell the community about? Anything that we can support you on? Tell us how we can communicate with you, how we can best get in contact with you and your team if we want to work with you.
Absolutely. So one passion project of mine is actually helping investors learn how to effectively and efficiently underwrite multifamily opportunities. So one thing that I started is I created a course around that. It's a 10-week program where I teach live beginning investors, specifically in the multifamily space, how to do that. So I'll be starting my next cohort soon, and where people can find out more about that as well as me and what I do is on my website, which is dbacapitalgroup.com. D as in dream, B as in believe, A as in achieve. My contact information is there, of course, the course information. And for listeners of the show, they can also download the complimentary copy of my book, The Busy Professional's Quick Guide to Investing in Multifamily, which I wrote with the goal of empowering and educating investors.
Excellent. So, we have a tradition here at the Strategic Multifamily Investing Podcast where we want to give people the boot. What is that one piece of action that you think could help spur people on to their the next thing? Give us the boot.
Yes, so I'll summarize it exactly in those words: dream, believe, achieve. Dream is having clarity of goals and knowing your why for the reasons that we discussed earlier during this conversation. Believe is surrounding yourself with positive, like-minded individuals and overcoming those limiting beliefs. And the last piece is the most important: achieve, which is taking action. Even if it's a small step, make that very first step forward, and then take another and another and another. And before you know it, you will be well on your way of making those dreams real.
That's beautiful. Thank you so much, Vessi, for your time. And if there's anything that we can do here to help you along your way, please feel free to reach out and let us know. So again, thank you again for this great interview.
Absolutely. I really enjoyed our conversation.